Is Greg here? Okay,
85.
wow.
She's
Oh, yeah. Enjoy it.
Whenever you're ready.
ready to go.
Ready whenever you are. He's gonna watch it. Yeah.
Well, welcome, everyone. I really appreciate you taking your time this evening to come and to sit and get schooled on 1031. What I find in the commercial industry is that many of the clients that I've worked with in the past aren't really familiar with what 1031 is, how it works, the structure of it, the importance of it, and the value it can bring to your real estate portfolio. So, and it's sometimes difficult to try to convey the value of that at the point through the real estate transaction. So I'm putting together a series of classes. This is the first in a series, and it's the 1031. So what do we do with that money? After you have a real estate sale, you have some capital gains. How are you going to manage that money? So I've asked Greg here, Greg Smith, leading with IPX 1031, to be our guest speaker this evening. And I've also worked with my title company. It's Fidelity National Title, Chicago Title. Joe Knapp and Ann Seaton. Ann Seaton's here tonight. Joe couldn't be with us. He's feeling down. But Ann, I want to introduce Ann and have her come up and tell us a little bit about the importance of title in the conveyance of properties and making sure you have a free and clear deed and making sure that everything within that language and schedules A's and B's and the whole document there is ready to go, so that when you buy that property, you're not buying any future encumbrances. So let me introduce you to Ann Seaton here. I've been working with Ann for a long time, many years. I think I used to have blonde hair when I first was introduced to her. But this is Ann Seaton. She's with Chicago Title, Fidelity National Title. So, Ann?
Yes, thank you. Well, welcome everybody. So first off, I wanted to share with everybody the connection between Fidelity National Title and Chicago Title. So Fidelity National Title is the largest title underwriter in the country. And then Fidelity owns Chicago Title. So you'll see that sometimes we write on Fidelity paper and sometimes we write on Chicago Title paper. If you have a preference, you can do either or. But I just wanted to kind of make the distinction between the two companies. So Fidelity owns Chicago Title. So our office is located in Westerville, and my office only does commercial real estate. We don't do any residential. Residential transactions are handled by the office in Worthington. And also we are national. So we do every state in the country. So if you have a client that is buying something here and has to sell something in another state, then I can do that for you. So we have that capability. So in regard to that title commitment that Mark was talking about, title commitment is so important. I call that the roadmap. So everything that you need to know about your transaction, what is needed to get your deal to the finish line, is in that commitment. So Schedule A shows us who owns the property, shows you what the legal description is. Schedule B2, that's your roadmap. So it's going to list everything that has to happen in order to get it to the finish line. And then Schedule B Part 2, that is where your exceptions are. So generally in Schedule B Part 1, that's going to show you what mortgages are on the property that have to be paid off, what liens, there are all kinds of miscellaneous liens, such as mechanics liens, state and federal tax liens, you name it, all kinds of things out there. And then anything unusual that we're going to need. So let's say, for instance, the seller owns a piece of real estate as trustee of the trust, then we're gonna need to review that trust document. It's gonna be set out in that requirement. Gotta look at the trust document. We're gonna need a certificate of trust. Gonna be set out, certificate of trust or memorandum of trust. That's gonna be set out in Schedule D Part 1. So title commitment's so important. So I always recommend that you read them before you send them out to your client. You have any questions about your commitment, ask your title officer. So you know, you certainly don't want to have any surprises, but it's all laid out in the title commitment. So,
Thank you. Ma'am.
you're very welcome.
Yeah.
So thank you for
Yeah,
the
so-
tonight. Also wanted to let everybody know we have some great tchotchkes back here. Please help yourself.
Yeah, so that is absolutely true, because normally when we take on a listing, we'll call for a title commitment, it's a pre-search. And we will be able to identify if there's anything of major that we should address early at the listing time, at the listing period. And so then we can move forward and get those items resolved, or at least bring it to your attention, so that they know that they'll have to be resolved when we go to a close. Because remember, if we can't close on the clean title, Greg doesn't need to be here today. Right? Because how are we going to transfer funds into a property? So we have some information out back, and if you want to grab our information, please do. I work with them continuously throughout the years of my business. Next. Let me introduce Greg Smith. He'll come on up here, Greg. He's going to go over some of the details and all the years that he's been practicing the 1031 exchange principles and the IRS rules and changes in the laws. He's going to go over that today. So and we're going to have a test afterwards.
Okay, it just lasts a few hours.
Just a few hours, okay. So this is Greg Smith, so you want to come on up? You want to?
All right.
on to it?
Yeah, oh, thank you. No, I don't think I need to lay it on.
Okay.
You want to stay and operate, or?
Yeah. I think you just give me a look. And I'll do it.
Okay, yeah, whatever's
Yeah.
easiest. Yeah, perfect. All right, well, hey, thanks so much for having me. I really appreciate it. 1031s aren't really slowing down much yet. Real estate is hot. These are still hot. This is definitely something you do want to know about. I've worked with several of you in the room already, and certainly would love to get to know everyone. I've been doing this over 20 years now with IPX. Really enjoy the business. So I'll just kind of jump right into it. So, you know, it does come from a section of the tax code, section 1031. That's where the name comes from. And the basic idea here is the government is nice enough in this case to say, if you don't pocket the proceeds, but you're willing to reinvest into more property, then they won't make you pay the state and federal taxes on that sale. And it's a beautiful thing that doesn't apply to everything anymore. It doesn't apply to the stock market. You know, if you sell your Microsoft stock, but you don't pocket the money, you put all of it into Amazon stock, you still have to pay all your taxes if your Microsoft stock went up in value. So it doesn't matter that you reinvested. But with real estate, this is a special tax break for real estate that you'll want to take advantage of. The power is absolutely huge. I've been doing this long enough now that I've seen people grow from owning one $50,000 rental condo to owning millions and millions of dollars of property and never having paid tax anywhere along the way. So it's a very beautiful thing to be able to grow your portfolio, get to bigger properties, get to more properties, get to different types of properties, and 1031 allows you to do that. It's not something that is new to the tax code. It's not something that's unsettled. It's been in the tax code for more than 100 years. Okay, it came in 1921, so 101 years now. So it's not going anywhere. We do have to fight with Congress about it because they like to do that. There's always, every new administration, doesn't matter which side of the aisle it is, every new administration that comes in, they have programs they want to pay for, right? So they always come in and, all right, we got to come up with the money to pay for this stuff. Nobody wants to go in and say they're growing the deficits, even though they all do. So they always have to say, here's where the money's coming from, here's how we're gonna pay. So every time we have to go back to Capitol Hill, we have to lobby. And what's strange is, and this would not be common sense to people, getting rid of 1031 will cost the government money. There's no question about it. So you don't have to feel bad about using 1031. 1031 helps the economy, and we can prove it in very specific numbers. Ernst & Young did a major study. They've actually done a study twice now over the years. And a couple of college professors, one from Syracuse, one from Florida, they also did a study. One was macroeconomic, one was microeconomic. I'm not gonna bore you with all these details. The bottom line is they showed very specifically the government will lose billions and billions and billions every year if they get rid of 1031. And the short logic behind that is a lot of sellers are savvy, and sellers aren't going to sell their property if they have to pay big taxes and can't reinvest. They're just going to hold their property. So it's going to slow the markets down. When it slows the markets down, that means a real estate agent's not making a commission. A 1031 guy's not making his couple of bucks. The title company back there, Ann's not doing deals. All the players, and there's so many players in the real estate market, the lenders, the construction workers, on and on and on. They're all doing less business. They're all paying less in income taxes. So you can prove that slowing down the deal flow hurts everybody. So 1031 is a good thing for the economy. I mean, I'm not gonna bore you with all the details because I'd like to. It's a 100-page report, but absolutely brings so many jobs to the economy and more money to the government. It would kill local governments to get rid of 1031 because they need prices to do well and deals to be happening, all those conveyance taxes and everything else that they're making money on. So this is not a tax break for the wealthy that hurts the country. I do a lot of deals each year that are $50,000 sales, and nationwide our average sale price is something around $300,000. That's even with those $100 million, occasional $1 billion deals mixed in. So yeah, 1031 is a good thing. It's been around a long time and it's not going anywhere. All right, so if you go ahead, thank you. There are so many reasons to use 1031. I was already discussing some of these with a few of you ahead of time. There's a lot of reasons to use it other than just not wanting to pay taxes you don't have to pay. A lot of it's about what you want to do with your portfolio. So, let's say you've got 3 kids that live around the country, and one's in Florida, one's in Texas, and one's in California. And you want them to be able to manage properties. So you sell property, you buy properties where the kids are located, you let them learn how to manage the properties. When you pass away, you let them inherit their respective properties in their areas. Things as simple as that for estate planning. Sometimes it's that you own bare land and you say, well, this is great, and I think it's gone up in value a ton through the years, but I want to get into something that's income producing now. So you sell your land and you buy an apartment complex, you buy some commercial office building, shopping center, what have you. Sometimes it's you own 10 rental properties around town and you say, you know what, I don't want to do all that traveling anymore. Let's sell the 10, buy one apartment complex and do everything in one place. There's just hundreds and hundreds of reasons why people use 1031 that really aren't about avoiding the taxes. That being said, let's talk about the taxes. So it's always worse than people think. I talk to people every day and they say, well, it's only 15%. My CPA says rates are going to go higher in the future. Maybe I'm just better off paying it now and not worrying about it. I just don't agree with the logic at all. First of all, the one thing you want to know is it's never just 15%. Always more than that. Even if you're selling bare land with nothing on it that needs to be depreciated, you're at least going to have that 15% plus state tax. So Ohio, talking about 5%. We'll see that in a minute. But for most people that own something with improvements on it, you got to worry about depreciation. You got to worry about higher tax levels. So check out the next one. Perfect. I think if you click one more time, yeah. Oh,
There we go.
yeah. It's hard to get used to. A lot of them take 2 clicks. All right, so the Affordable Care Act, Obamacare added a 3.8% tax that kicks in when you hit certain income levels. So on larger deals or clients with higher incomes, another 3.8 on top of the 15%. Can move forward, please. And these numbers, I think, have actually been adjusted a little higher to inflation yet. And I don't think I've updated this, the exact numbers, but when you hit higher income levels still, it goes up another 5%. This came out of that fiscal cliff thing 7-8 years ago now. I lose track of time, but it's been on the books for a while now. So on large deals or high income, you're at 23.8% to jump off with. Okay. And then people forget about the depreciation. I know a lot of you are real estate investors in here. Sometimes I'm dealing with groups that aren't going to be as involved in you and they don't know about depreciation. But for those of you who don't, it's the idea that the buildings we're in are crumbling away over time. So if you're in a commercial building, they came up with a idea that it crumbles in 39 years. If you're in residential property, they say 27.5 years. So that's a great tax break again you get as a real estate investor. So let's say you bought this building, let's just make up and say it's $5 million. And they deem that $1 million is the land value, $4 million is the value of the improvements, the building. You take that 4 million, and in this case, you would divide it by 39 because it's commercial property. If this was an apartment building, it would be 27.5. And that's the tax break you get each year. And that's a beautiful thing. Because the rents you're making on your property, you can use that to offset all or some of it, depending on how much is coming in rents and how much your depreciation credit is. So it's a beautiful thing. However, you've done well on your property. You go to sell this building years down the road. It hasn't gone down in value as was predicted by the government with their straight line depreciation. It's gone up in value. So now Uncle Sam is going to stick his hand out. He's going to say, wait a minute, we gave you all those credits through the years. We shouldn't have given it to you. Your property went up in value. We want our money back. So they take the total of the credits you've received through the years, they tax it at 25%. So not only can it be the biggest tax in a lot of deals, it's one a lot of people don't see coming. They forget about or they don't know about it. And also it's one that really can sneak up on people if they felt like their investment wasn't even a good one, right? They bought this apartment complex for $800,000 many years ago, and now here they are selling it for right around $800,000. They think, you know, this is terrible. I did horrible on this investment. But maybe they forgot they took $500,000 of depreciation credits through the years, and they're going to pay a 25% tax on that $500,000. So that can really sneak up on people. So you don't want to forget about all these other taxes that apply. All right, one more set of taxes, like I mentioned earlier, the state tax. Ohio's not the worst. We're just under 5%, really, when all is said and done, is what it comes out to in Ohio. You look out there at the left coast, California gets you at 13.3%. Right? And we do have a lot of investors that are selling in California and buying in Ohio or the Midwest or somewhere else. So you can kind of take advantage of that. If you leave Ohio and buy in Florida, Texas, Nevada, a few other states, you can go from a 5% tax to a 0% tax at the state level. That could be nice. Get rid of a little bit. But every state had its own quirks. Pennsylvania was the last one to get on board. It just recently passed 1031 at the state level. It was the last state to do so. So starting January 1st, all 50 states will respect 1031 on their state level taxes as well. Obviously, the biggest part of the tax is federal, so you've always been able to use 1031 for that. But states have their own rules. Pennsylvania, up until almost now, has made you pay the state level taxes when you sell. Now all 50 will be on board. But all kinds of quirks are out there, withholding rules, things we'll help you with. California is a big one because again, so much activity is going on out there. When you sell in California, decide you want to reinvest in Ohio, maybe you move here, you want to keep your rental properties around you, let's say, or your commercial properties. Well, California has something called a clawback provision. Okay. They're not nice enough just to say, oh, sure, leave, go somewhere else, and we're not going to tax you. What they say is, you need to do a filing with us from now on. So every year you file in California and say, hey, I've not yet sold my Ohio property. And then if one day you do sell Ohio and you don't do another 1031 exchange, that's where California claws back in the deal to get their taxes. So 4 or 5 states currently have clawback provisions. California is the big one, and again, it matters because it's 13.3% out there. So, yeah, thank you. So we like to use the term in this industry, swap till you drop. All right. It's a home run, not that anyone needs to be in a hurry and nobody needs to die to get a tax break. But when you do pass away, that's when it becomes a home run and your heirs are very, very happy. Because what happens is your estate should end up paying 0 in taxes. Your heirs get what's called a stepped up tax basis. If you leave them this building and they're saying it's worth $5 million at the time you pass, your favorite daughter gets it for $5 million. She says, well, I don't want to manage that property. So she sells it the next day to someone for $5 million, 100% tax-free money. Taxes go away. So that's a home run. There's some other tax breaks we'll talk about in a few slides. That can be nice as well, but that's the biggest one. Get in your estate, the taxes go away. So the last thing you want to do, you're 110 years old and you're on your deathbed. Don't sell your property then and pay the taxes. I have a lot of people come to us and say that they say, Greg, I don't want to leave a tax burden to my kids, things like that. They think they should sell and pay the taxes. I'm saying, no, your kids are going to be much happier with you if you hold on to that property and can just pass it to them tax free. You don't sell at the last minute. Don't do that. All right. I should have said earlier, please talk, make comments, interrupt me, ask questions anytime you want. I want to be interrupted. I want to have conversation. I want to make sure we're talking about the things you want to talk about. Any specific questions you have get answered. So any questions so far about the taxes? Okay. Yeah, they're always more than you think. Yes, sir.
Got a quick question.
Please.
So, in residential sales, is there a capital? What's the capital gains on residential sales for a single person and a married person? And then the question is, maybe it's $500,000, right?
And you're talking about the sale of principal residence.
Yeah.
Yeah.
Now, let's say I sell the principal residence, but I sell it for millions of dollars.
Right.
And now you over exceed the tax reprieve, I guess, whatever. So what happens? Can that be used for 1031?
Right. Well, I'm gonna have a slide on this a little bit, so you're gonna get more detail later.
Should look at your slide.
But, oh yeah, no, it's a good question. So, the short answer for now is under section 121, which deals with principal residences, like you alluded to. As a single filer, you don't pay any taxes unless you have more than 250,000 gain. As joint filers, you have to have more than 500,000 gain. So the government, again, is nice enough there to say we don't really want to make people pay taxes on the sale of the principal residence. There are some qualifications. You need to have lived there for at least 2 of the past 5 years when you sell. A few other things to meet, but most of the time, people don't have to pay taxes. Now, I had a guy out of Cincinnati a few years ago. I was going through a deal with them, and he was talking about selling this property for over $2 million, the taxes, and want to use 1031. And we were pretty far into the conversation when I realized he was selling his principal residence. This was many years ago now. It's probably 18 years ago. He had a very expensive residence down in the Cincinnati area. So I said, well, I have bad news and I have good news. The bad news is 1031 doesn't apply to you. The reason is 1031 is only for real estate that's owned by a business, used in a business, or held for investment. So, if you own this building, right, you're using it as your brokerage here, it's your business, 1031 eligible. Or if you own rental properties that you rent out to other people, 1031 eligible. But it's a place you live, they consider personally held property. And the same thing applies to pure vacation homes, ones you don't rent out, but you just use for your family. Those are not 1031 eligible. So I had the bad news for him and I told him that. The good news is I have a plan for you. Go back to your buyer, say you're going to revamp the deal and you'll sweeten it for them somehow. But rent it. They can move in right away, but you'll rent it to them for 2 years. Then you'll buy at your new price 2 years down the road, do the 1031 exchange. That's exactly what he did. He didn't want to pay more than 1.5 million in gain, which is what this guy had. It was almost all gain on the sale. And that small exclusion wasn't going to do enough for him. So,
The key thing is to rent it back for 2 years.
yeah, I mean,
And if you don't have 2 years, you're out of luck.
right, again, this isn't gonna apply to a lot of people. Most of us are not lucky enough to have huge gains on the sale of our principal residence, so usually it's tax-free. But if you do have that huge gain, yeah, that's something you can consider. Move out of it, start renting it for a while. It wouldn't even have to be 2 years, but we'll get into that in a little bit. All right. But yeah, that's the idea, that's the concept. So 1031 always has to be business or investment. Yeah, thank you. Yeah,
I got a question. You're talking about the older, whatever, it's 100 years old. Are you talking about step out basis type of thing? Instead of a 31?
right. Anytime you die with real estate, whether it was part of a 1031 or not, the real estate can get passed on to your heirs with a stepped up basis.
Yeah, so
Yeah.
those are tax free. I mean, those, I don't call it tax free, but the previous value becomes zero, right?
Yeah, I mean, really, it is tax free at that.
Yeah.
Tax free to the estate, tax free to heirs. Now, if the heir holds on to the property for 10 years and during that period it goes up more in value, then they'll pay some taxes when they sell it for what happens. In addition to that value that when you passed. But if they sell it for what it's worth at the time the person passes, tax free.
Is there something like a time limit on that step out thing, like a step out basis? There's like a certain time limit you have, let's say you inherit the property from your mom.
Sure.
Right? And who just passed away, there's like a specific time limit, they have to sell the property. To get under the qualify.
No, not at all. I mean, whoever inherits it, the new stepped up basis is supposed to be set at the person's death.
Okay,
You're
yes.
supposed to do that at the time the person inherits it.
Time.
So then at that point, it's set.
Yes.
And then, whether they sell it a month from then or 20 years from then, that's their tax basis moving forward.
Okay.
Yeah.
Okay, thank you.
Yeah, thank you.
So the stepped up value, is that determined only through an appraisal? Or the sale price?
An appraisal's the best and safest way to do it. I don't think technically it's required. Everyone could agree on it. I
But
don't
if
think.
two parties agree on a sale, then that's the stepped up value, isn't it? Like if you're selling your property, I'm buying it and,
Yeah.
we agree on the sale price, is that the stepped up value or would it be? an
I think you're
appraisal?
supposed to determine the value at the person's death.
Yeah.
Right. So I don't think you can say 2 years later, I sold it for this, so that's what it's worth. It's gotta be the person's death. Yeah. All right, great. All right, so, we go back, I think I skipped over one. Yeah, so like kind property, you hear these called like kind exchanges. And it used to mean more, because before the Tax Cuts and Jobs Act in 2018, things were very different. In 2017 and before, on any given day, I was doing exchanges of aircraft, of business equipment, of fun things like artwork, racehorses, collectibles. Anything with a capital gain used to be 1031 eligible. The only real exceptions were stocks, bonds, and notes. Those were never 1031 eligible. But almost everything else that existed that could have a gain that you'd have to pay taxes on, you could use in a 1031 exchange. So the government had rules. Why they have a lot of these rules, no one really knows. Why they matter, no one really knows, but there's a lot of rules. If you sold an aircraft, you had to buy an aircraft. If you sold a certain kind of business equipment, you probably had to buy really the exact same thing or something very similar to it to qualify in a 1031 exchange. But within real estate, it's always been incredibly flexible. It's any kind of business or investment use real estate can be traded for any type of business or investment use real estate. So it's perfectly okay to go from retail to single family or the single family rentals to industrial, bare land to a shopping center, on and on. Anything for anything is like kind if it's business or investment real estate being traded for business or investment real estate. So that confuses people. A lot of people don't do exchanges because they say, oh, I'm selling a duplex. I don't want to go buy another duplex. I mean, I've heard this hundreds of times through the years that people learn it and they say, oh, if I had known, I would have been exchanging all along. And it's kind of painful. But the Tax Cuts and Jobs Act got rid of 1031 for everything except for real estate. Now it only applies to real estate. But it hasn't made my job better in the long run, but it's made it simpler. I don't have to worry about a lot of those questions anymore. Real estate's been hot since this happened in 2018, so we've still been going crazy and it's all 70-hour weeks. Someday the real estate cycle will slow down some. When that happens, I'm not gonna be able to fall back on talking to companies and doing exchanges of their giant printing press for the new printing press and aircraft and those things again. So eventually it'll be painful, but right now, thankfully, real estate's hot, so it's not a big deal, but don't be confused.
What's the last, the bottom one, like the person who did?
Yeah, percentage interest is a TIC. So TIC stands for tenants in common. And that's anytime you own property, multiple owners just owning it in their own names. So if you and I own a property together, we're 50-50 owners, and our names are the ones on the deed, as opposed to we set up an LLC or general partnership or corporation, own it in some kind of entity. Instead, we just own it in our own names. That's considered tenants in common ownership. You're considered separate owners of the property, not any kind of partnership or entity. And they let you buy or sell percentage interest in a TIC. They don't let you buy or sell percentage interest in a partnership. Okay, so if the two of us had a 50-50 LLC, I can't turn around and sell Jim my 50% interest and do a 1031. Because the IRS says, no, we don't want to track that, we don't want to deal with it. Now, what I can do is maybe drop my interest out and then sell him my interest coming out of my name as opposed to the LLC. There's all these creative things you can do to make it work, but you can't buy or sell a partnership interest or LLC interest as part of a 1031 exchange. With the one major exception being, you can buy or sell 100% of the membership interest in an LLC because you make it a disregarded entity. And this actually comes up, so I'll bore you with this real quick. A disregarded entity is because the IRS ignores a single member LLC, for example. They don't exist to the IRS. At the federal level, you have C corporations and S corporations, you have different kinds of partnerships, and then you have sole proprietors. You don't have single member LLCs. A multiple member LLC, 2 or more people, that's a partnership under federal law. So LLCs are state law creations. You can go form an Ohio LLC or a Delaware LLC and so on. The feds ignore it. And because of that, you have some flexibility when it comes to a lot of things 1031 wise. This is huge in Ohio. Some of you have come across it, but you want to know about it because if you get into a real estate deal, someone may ask you for it one way or the other. Ohio is really the only state that does this right now, where you can still get away from hiding the sale price from the counties. Okay, so instead of just doing a deed from me to you and it shows, oh, this property was worth $500,000, instead, I can set up a new LLC. I can transfer the property into my LLC and then transfer 100% of membership interest in that LLC to you. So you've acquired the property without telling the county how much it costs. That helps people a lot in certain situations because either their taxes don't go up or it takes a long time for the taxes to go up. So we see a lot of these type deals in Ohio where people are selling 100% of the membership interest in LLC, and it's perfectly legit. It's not against the law, so people use it, and it works for 1031 purposes as long as you're transferring 100% of the membership interest in what they call a disregarded entity, a single member LLC. So this wouldn't work, for example, if my wife and I own a property and we deed a property down into an LLC and then transfer the membership interest. Because the IRS says, oh no, that was its own entity. That was a partnership with 2 people, Greg and Mara, in it. So it doesn't work for 1031 purposes. We can't exchange in that situation. It has to be if I own the property alone, or an LLC owns it, or a corporation, something that you deed it in, you make the LLC or the individual or the corporation the sole owner, then you do it. So it gets more, if you have 2 people as tenants in common, my wife and I, let's say, owning a property, we would actually have to deed down into 2 separate LLCs, one for my 50%, one for hers, transfer those to the buyer, and you can accomplish the same thing, just a little more complicated. All right, getting off track, getting too technical, I know we're gonna put people to sleep, but it's good to know that stuff because it really does come up a lot in Ohio. All right, here's the basic rules. This is also not common sense, and the average person does not understand it. Okay, because a lot of people come in and say, all right, Greg, I just want to reinvest my gain and not pay any taxes. Or I just want to spend all the proceeds and not pay any taxes, things like that. Well, that's not how it works. When I said at the beginning, the IRS wants you to be in a position where nothing has changed, that you own property B now that you've acquired instead of property A that you sold. But the numbers are equal or higher. You haven't pocketed anything, you haven't been relieved of debt. That's what they want to see. They want nothing to have changed. They see that, no taxes are due. So here's what it is specifically. They start out by saying they want you to buy a property of equal or greater value. That's not totally true. Because real estate, the fees, the real estate commissions, title fees, the things people in the back room like, those come off the top. All right, so you're not expected to make up for real estate commissions, closing costs and things like that. That's nice. The government doesn't make you reinvest that portion of it you're already paying out. But they do want you to reinvest the net proceeds that are left. So don't pocket anything cash from the sale. If you do, you're gonna pay some taxes on that portion. Number three, replace the value of the debt. That's the part a lot of people don't understand. If you're paying off $400,000 on your closing statement to the bank, they want you to go get a new loan on your new property of $400,000 or more. So it's matching up. Now, if you decide to buy a nuclear waste dump and no bank will make you a loan on it, there is a way to still become tax-free. You're just gonna have to add $400,000 of your own cash instead of borrowing it from the bank. So you can offset the debts on the sale with either new debt or new cash from outside of the exchange. Some combination of the two. Number four doesn't come up too often. Receive nothing that's considered non-like kind property. Let's say you sold, as an easy example, $1 million of farmland in Ohio, and you bought $1 million hotel. At first, that looks perfect. But if it's a working hotel, then we know there's going to be more to the purchase price than just real estate. You're really buying kitchen equipment and furniture and things that the IRS won't call real estate. Things that Mark's going to teach you about in your next class on cost segregation, where you would go into that hotel, you would use a cost segregation study, you would chop everything up, and you would get additional tax breaks from that. So there's a plug for your next, so everyone's going to show up to that one too. So, yeah, in this example though, if you sold $1 million of farmland, bought $1 million hotel, the IRS would say, okay, that's $1 million of real estate on the front end, and say 700,000 of real estate on the back end. So you're either going to pay tax on the difference, or you need to go out and buy a second property. Okay, so that's what it means by getting something that's not like counting.
Then you go back. So for the first point, like equal or greater, right?
Right.
Suppose you have a property of $1 million, right? So you invested 200,000 initially. Right, so does that 200,000 has to be included in this one, or we can take that one?
Right, so you want to think of it, there's two different math problems, and I'm not going to make anyone do math tonight, but the first one is if you're paying the taxes. Let's say you're just doing a regular sale and paying the taxes. Then the 200,000 that was your original tax basis when you bought the property, then that matters. So if you sell it for $1 million, you have 800,000 of gain. You're only going to pay taxes on 800,000 of gain at that point, right? But when you're doing the 1031, now the IRS does not care about that 200,000. They don't care about what your tax basis is. They just want to pretend nothing's changed, really based on, you can say your sales price or your net sales price. Again, you have to take the closing costs off the top, then that's your magic number. So sell for $1 million, 100,000 of closing costs. Let's say there's no debt for an easy example. So you're actually getting 900,000 of cash. They need you to reinvest the whole 900,000 cash to owe no taxes. If instead you also paid 400,000 bank and you're walking away with 500,000 of cash, you need to use the 500,000 of cash as down payment, get a loan for 400,000 on your property. Now you owe no taxes. Now the average exchange, people are going and buying more expensive property. So they use all the cash as down payment. They borrow as much as they can or as much as they need for that property. But if you go down in value, you're going to owe some tax no matter what, by more than the closing costs. So you're either going to get cash going back in your pocket, or you're going to have debt that's not replaced. that part of it will be what they call boot, either cash boot or mortgage boot. That you owe taxes on. That makes sense?
One more question. on
Please.
the Previous slide, if you don't mind, about the 50% of, like, if the LLC has a 50%. Like, we both own a land and we have 50% partner, right?
Oh, gotcha.
But if we sell it, right, so do we have to carry that LLC as long as that property or the next property exists, like?
Yeah, so if you're in a partnership, two-member LLC or more. That is considered its own taxpayer, right, has to file its own tax return. Unlike in a single member LLC, you don't have to file a tax return, that information goes on your own personal tax return. But when you've got two people in it, so if you sell a property, you do have to show the IRS it's the same taxpayer completing the exchange. So you're either gonna buy in that same LLC, same name, or if, let's say, you named your old LLC, 41 South High Street LLC, so you don't want to use that as the name of the new place. Then what a lot of people would do is just set up a new LLC, whatever one you want to name it. But 41 South High Street has to be the sole member of the new LLC. And then it works, because the IRS will still see the same taxpayer on those sites. But in general, yeah, you gotta have continuity of taxpayer.
One more thing.
Please, good questions.
So when we bought this land, right, we did not buy under LLC, we bought under our names, right? Then later we created the LLC, but we never transferred that land to the LLC, still exists on individual names, but we filed tax as an LLC.
Yeah.
So how does that work?
Yeah, I see that all the time. And I think the correct way to deal with it, because if you sell it in just your names, our company, we'd be forced to treat it, shut up the exchange in your names. We can't set up the LLC because the IRS said, no, that's not what went on. So I think the best way to handle that is in your contract, when you would go to sell it, tell your buyer, hey, we're actually going to deed this into our LLC before we deed it to you. So we'll sign the contract as the LLC. That way, by titling it to the LLC before you sell it, it matches up with what you've been telling the IRS. And then you would do your 1031 exchange in the LLC name. That's really how you want to do it there.
I got it.
Yeah. Great questions. Yeah, these are practical. They come up a lot. All right. Wait, the next. Okay. All right, perfect. Yeah, this one. Oh, back one. Oh, no, sorry, next, wherever we're on, next one is. All right. Quick example on this stuff. It's actually two examples. All right, we're saying you're selling a property for $1 million. 300,000 of debts paid off on the closing statement. You got costs of the sale, again, real estate commissions, title fees, those things of $60,000. But you're walking away with net proceeds of $640,000. Now, the first thing you want to understand is in a 1031 exchange, sometimes I forget to say this during my presentation, you can't touch the money, okay? If you touch the money or even have the right to touch the money when the closing occurs, it becomes a taxable sale. So that's why we're called the qualified intermediary, our company. We get involved before that initial sale takes place. We end up getting assigned into your contract as the technical seller on your behalf. The money comes into the exchange account with us. And then within 180 days, you've got to reinvest it. We're going to talk more about the time periods. But don't let your closing go by. Don't let them give you a check or wire you funds. It does become taxable when that happens. So when I say there's net proceeds of 640, Ann back there is going to wire those funds into the exchange account that we've set up on your behalf, and it's going to be held there. And then you're out there looking for your replacement property. Next, please. Okay, I have to click a few times. All right, perfect. All right, so in this example, the Sullivan Group finds you the perfect property that you wanted. It's 1.3 million. You're very happy. That's what you wanted. You move your business, let's say, into that property. The debt was 300,000 when you paid it off. You get a new loan for 660. You use the cash as a down payment. You don't have to come out of pocket for any more cash. You're happy about all that. This is kind of the most standard type of 1031 exchange. No taxes are due because you went up in the debt, stayed equal in the net proceeds. Perfect. Don't know Ohio anything. Don't know the feds anything. Click the next one, please. Now, in this example, because the Sullivan Group is so good at what they do, he goes out and he negotiates the seller down. He was looking for $1 million properties for you. He gets that seller down to 800,000. Well, that's still a good thing. You still want to get the property as cheap as you can. But because you've gone down in value, you don't need as large a loan. The loan went from 300,000 to 260, and you end up pocketing some of the cash. You had 640 to use, you only use 540 of it. You've got $140,000 of taxable boot. This might not be the end of the world. Again, you could go out and buy a second property if you want, be 100% tax deferred. There's other kinds of investments we'll talk about in a little bit that you might throw money into. Let's take the first example, kind of like this gentleman's example a minute ago. Let's say your tax basis was $200,000. You've got 800,000 of gain here when you sell it for $1 million. Well, of that 800,000 of gain, you're only paying taxes on 140,000 of it, deferring the taxes on all the rest. That's still a win. That's still a lot better than paying all the taxes. But let's say maybe you only bought this property a few years ago and the tax basis was 900,000. You had $100,000 gain you were trying to avoid, and you only ended up buying property for $800,000. That's not good, because you're not gonna have to pay tax on 140,000, but you'll still pay the taxes on the 100,000 of gain. And in essence, the 1031 didn't do you any good. So you wouldn't plan this ahead of time if your tax basis was 900,000, or you'd have to go out and buy a second property to make this make sense. All right, does that kind of make sense somewhat? I know we're throwing a lot at you in a short time. Most of this stuff is in this book. Take a look through that. That'll help on a lot of these topics that I move through quickly. All right. Flying along. Okay. Another call I get quite often is someone walking through what seems like a perfect 1031 opportunity, but I'll ask, how long have you owned this property? And they'll say, well, I've owned it for 3 months. I say, okay, so tell me more. And what's interesting is it comes down to a lot of gray areas often as to whether they're 1031 eligible or not. The IRS calls it an intent-based test. So there's no rule that you have to own your property a certain length of time before you can use 1031. Instead, the rule is, what was your intent when you bought it? If your intent was to hold it for investment, so you bought it and you thought, I'm going to hold this and run it for the next 20 years. But Jim comes up to me the next day and says, Greg, I've always wanted that property. I did my loan put together in time. I'll pay you $100,000 more today than you paid for it yesterday. Great, yeah, that sounds good. I can sell to him. I can do a 1031 exchange, even though I owned it for 1 day, because my intent wasn't to sell it. I got an unsolicited offer, decided to take advantage of it, normal business decision. Now, if I buy it and I say, you know what, I really want to be in the business of flipping properties. I want to buy it, I want to rehab it, I want to sell it. I want to do that every 3 months over and over and over. The government says, yeah, we're not really wanting you to be able to use 1031. We consider that to be the inventory of your business, not really any different than MI Homes or some big home builder, where you're buying it, you're building homes, you're selling them off. That's a business. That's the inventory of your business. You got to pay ordinary income taxes. We don't want to give you capital gains treatment or 1031. So there's a ton of gray area there. Did you really intend to hold it? Did you really intend to flip it? What about if it's maybe neither or both, where you say, oh, I'm buying it, market conditions are crazy. Maybe I'd sell it at the right offer. Maybe I'll hold it as a rental. Maybe I'll see how things go. So tons of gray area, but it comes down to what your intent was technically. If someone comes and says, well, my intent was kind of both, I might say, yeah, I mean, I'd be fine with doing it. I would do it, but on your next one, don't do it again. Don't buy one and sell it 3 months later on your next one if the front end looks suspect, right? You got to at least make it look good. So it's interesting, but it's all about intent. I'm going to skip over that other stuff so we can go to the next slide because this is going to be coming up again later. All right, 45 and 180 days. We've kind of been alluding to some of this. Called a delayed exchange, standard 1031 exchange. So from whenever you would sell it, today's your closing date, next day is going to be that day one. They only give you 45 days to identify what you want to buy. That's really the hardest part of a 1031 exchange for most people. Then you have 180 days, which also runs from the date of the sale. So it's 45 plus another 135 to get closed. That's usually easy. Sure, we see a few tens of thousands of exchanges each year. We'll see a few where they have trouble getting closed by the end, but that's usually not the problem. If you're identifying what you want within 45, you typically can get closed within another 135 days from then. There's no mercy on this, okay? There are two and only two ways to get extra time, and they're really not things you want. The first is military deployment. If they send you overseas to fight in a war, they aren't nice enough to say, we'll give you extra time. So none of us probably want to deal with that. Number two is a federally declared emergency. So these come up more often than you would think. We've got them going on right now in Florida, North Carolina, South Carolina, and various other parts of the state from other types of country, from other parts of other types of disaster. So, excuse me, so even then, you have to be affected by it. In other words, just because there's a disaster somewhere wouldn't give us in Columbus, Ohio, extra time. It has to be a situation where, oh, I was gonna buy a property at Fort Myers Beach and it's not there anymore. You know, yes, that will get you extra time. But you don't get it for no reason. You have to show how you're affected. Excuse me, but other than that, there's just no mercy here. You don't get extra time for weekends or holidays or calendar days, and you have to get it done in time or pay your taxes. There are some interesting things. I'll talk about one in a couple more slides, but let's say you were selling December 1st and you identify what you want within 45 days. It gets to be April 15th and you haven't completed your exchange yet. Well, what happens? Don't file your taxes. Okay, if you file your taxes, you've killed your exchange and your taxes are owed now. What you need to do is ask for your automatic extension. That will get you your full 180-day period. You can finish your exchange, then file your taxes. Okay, so that doesn't come up too often. But if someone closing right at the end of the year, if they don't close quickly on their replacement property to where they're done by April 15th, they would need to ask for the automatic extension. But the good news is you can't always get your 180 days in. Yes, sir.
In just experiential, what percentage of people are actually in contract for one of the three properties that they have?
What percentage are in contract within the 45-day period? I would say a pretty high percentage over time, over about 20 years of I'm looking at this, probably 75%.
So generally in contract.
Yeah, and a lot of those people are in contract before they even sell their relinquished property. That's perfectly okay to do. You don't have to wait. You know, if you know your closing's coming up in 30 days, get out there and get looking for your replacement property. If you don't already know, get into contract as quick as you can. In a perfect world for you as the exchanger, if you can get that seller of the replacement property to agree to a contingent contract, then you're going to feel completely safe, contingent on the sale of your other property going through. Sometimes they're not going to agree to that, especially in really hot markets. But sometimes they will. And so that's ideal. And if they won't agree to that, then maybe you wait until you're very confident your deal is going to go through and you take the risk and sign the contract and hope for the best. Or maybe you wait till the money is actually in the exchange account to go out and do that. Just a market decision based on if you think that property will still be there and how much you really want it, right? But I think the vast majority are probably in contract, especially these last couple of years. Obviously, there are people that got in that situation where they would identify, say, 3 properties by day 45. On day 50, all 3 have sold to somebody else. Guess what? The IRS, again, no mercy. The IRS says, we don't care who owns those. You can still go buy them. Go negotiate with the new owners. It's not always realistic. But that's what the IRS would definitely say. Yes.
So I'm just confused about the 45 day. Is that, is the 45 day part of the 180 day?
It is, so it's 45 and then another 135 after it for the full 180. Yeah. Yes, that's right. Yes,
So the definition of identifying the potential, like, it's like you have to get into kind of sign a contract.
yes, you don't have to be in contract. It's really as easy as you could write down an address, that counts as an identification. Yeah, and we'll talk a little, there might be the next slide, I can't remember what order I put it, but we'll talk about identification in just a moment in a little more detail. But yeah, so you're not required to be in contract. It just can be if you can get into contract, your exchange will be that much safer, much more likely to succeed. Right, than if you just name some and maybe someone else is gonna go buy those, or maybe you're gonna do your own due diligence, not like those properties anymore. Once you're past day 45, you can't make any changes, so the faster you can move, the better.
So you can identify as many properties as you want. But like 100.
They're limited, so I'll put you off on that one because it'll be coming up in just a moment, we're gonna see the details. Was there any other question for now? Okay. All right, we'll do this mini deferral, and then we'll be on to the ID. So the mini deferral can be a bonus of even a failed 1031 exchange. So let's say you're closing on your property with Ann back there on December 1st. And you're in the position where you don't already know what you're gonna buy, you're out there looking. You just don't find it. You know, that happens sometimes. I mean, the vast majority of our exchanges are succeeding. I would still put it even during COVID, 90% plus of exchanges are successful, but some fail. Some just, that happens. People don't find what they want or can't close on it, or sellers back out, all the things that we know can happen. And you don't find what you want in that 45 days. So the middle of January, our company's gonna wire your money back to you. You get it back on day 46. You're gonna end up paying taxes. But the good news here is you could decide to put off your tax bill. So let's assume for a minute it's an all cash sale. You don't have to pay off any debt. That's the simplest example. You're getting your money back, not in 2022 now, but you're getting your money back from the QI in 2023. Because of that, you're allowed to report it as an installment sale where you didn't get paid till 2023. Now you don't have to pay your tax bill till April of 2024. That can be nice. That cash flow stays in your pocket. You can earn the interest on that, or you can go invest it, do what you want with your money, pay that tax bill later. Okay. The same thing applies to the 180-day period. So it makes it much more powerful in the 45 days. So let's say you're closing on September 1st. You do identify properties you were interested in, but for one reason or another, you don't close those. Either you later were not interested, or they sold to someone else, all those things we're talking about. Then the same thing, you're gonna get your money back after day 180. You're gonna end up having to pay your taxes, but you could put the tax bill off for another year. Now, I do want to point out, if you had mortgage debt on the property you sold in 2022, the IRS still sees it that you were relieved of that mortgage debt in the previous year. So you got the mortgage debt relief in 2022, you got the cash back in 2023. Some taxes can be deferred till next year, some need to be paid on the 2022 tax return. So anyways, throw that out there. We'll go to the next one now. I don't want to spend too much time on that. Now to your question, sir. All right. They came up with really strange rules here. And I think it's entertaining enough to hear the Starker story. You may have heard 1031 exchanges called Starker exchanges at some point. And that's because Starker really, we owe Starker a lot. He was this guy who owned a ton of timberland out on the West Coast, California, Oregon, Washington, other states. This giant paper company came to him. They figured out how much timber this guy owned, and they wanted to buy all of it. And they threw a dollar amount. He just couldn't believe how rich he was. He said so many zeros on this number. He immediately said no to their deal. They thought it wasn't enough money. That wasn't it. He was a smart guy. Back then, this is happening in, I want to say 1961, 1962, right in that range. The capital gain rates on someone like him on a deal like that were 50 to 60%. He was going to lose more than half his money from that giant sale. Taxes. He said, no, there's got to be a better way. He eventually figured out 1031. He went back to the giant paper company, who, by the way, had upped their offer 3 or 4 times in the meantime. So he's getting even more money now. And he said, all right, here's what we're going to do. I'm gonna deed you all of my property today, and you're not gonna pay me anything. So, all right, this sounds pretty good so far, Starker. We know there's a catch. What's going on? Well, I'm gonna go find properties, and my great agent out there looking for me, for find these properties I want. Then Giant Paper Company, you'll pay for those for me and have them deeded into my name. Great. Our only thing is we're a publicly held company. We can't have an indefinite liability on our books. Mr. Starker, how long is this gonna take? He said, I can get it done in 5 years. All right, it actually only took him 2.5 years to find all the properties he wanted. He said to the IRS 3 years later on his tax return, here's what I did, IRS. Sold all this property, bought all this property. I own nothing. I did a 1031 exchange. Understandably, the IRS freaked out. They said, no, you can't do it that way. You owe, failed exchange, pay up. Well, he fought it and he fought it and he fought it. And about 20 years later, after many courts of appeals, he won. And the Court of Appeals said, no, Starker did all the right things. He followed the rules the way you have them laid out, IRS, didn't touch the money, did X, Y, and Z, played by the rules, he wins. At that point, the IRS freaked out because they couldn't leave things there. That was the precedent. Nobody smart would ever pay taxes again, right? You'd sell property. 10 years later, if the IRS knocked on your door, you would say, hey, I'm still out there looking for my replacement property. I'm not paying these taxes. I'm doing a 1031. So no one will pay again. So there had to be time limits. In hindsight, I think the IRS could have just said, get it done in a tax cycle, get it done in a tax year. That would have been fine. But instead, they went overboard on all these rules. And this is really some of the worst of it. So they didn't like the idea because before they made these rules, there were people who would staple the New York City phone book to their identification and say, somewhere there is the property I'm gonna buy. People were literally doing it because you had to identify it. People didn't know, so they would do crazy things like that. And honestly, the IRS should not have cared. It didn't really matter, but they did care for some reason. So here's what we've got. The 3 property rule. You can always identify up to 3 properties with no restrictions of any kind. So the IRS thought this was very kind. They weren't just calling it 1 for 1. That's how they thought of exchanges. They were giving you a couple backups. Something went wrong, buy B or buy C. They thought this was very kind. People came back and said, well, wait a minute, IRS. I'm selling this $1 million property that I inherited years ago. I don't want all my eggs in one basket anymore. I want to sell this. I want to buy 10, 100,000 properties around Columbus or around the country. I want to be diversified. That's what I've told them. I want you to be diversified. So they want to do that. And the IRS said, oh, all right, we're going to need another rule. The 3 property rule doesn't work for that person. They came up with the 200% rule. If you name 4 or more properties, the total aggregate value of all the properties you name can't exceed 200% of the value of what you sold. So if you sold for $1 million, your 200% limit is 2 million. Okay, again, think back. It doesn't matter. That rule doesn't matter if you're naming 3 or fewer. If you're naming 3 or fewer, you can name a property for $1 million, second property for 2 million, and a third property for 100 million. That's fine. 3 or fewer, no restrictions. But if you want to name a 4th property, you'd have to completely redo it because you have to stay within the 2 million limit in that example. So they're strange rules. They really are strange. I mean, they could have done this much better, but they didn't. Now, they came up with this 95% exception. They said if you break the first 2 rules, meaning you've named 4 or more properties and the value exceeds 200% of the value of what you sold, they'll accept it as long as you acquire 95% of all the value on your list. So basically of your list, if even one thing you can't close on, you probably have a totally failed exchange. You don't want to use the 95% exception, stick to the 3 property rule or the 200% rule is the takeaway there. So these are strange questions about these.
So what, like 3 properties means you can identify 3 and take 1 out of that?
Yeah, you can identify 3 and then you can end up buying 1, 2, or all 3.
Or all?
Yeah.
So
Yeah.
maximum 3?
Yeah, under the 3 property rule, maximum 3. Now, again, if you're doing 4 or more, that's only going to work when you're naming some properties that are less expensive than the one you sold. So we do have a lot of people who use a 200% rule, but it might be that they're selling for $1 million And they end up thinking they're gonna buy 2 properties at 500,000 each. Right, so they end up naming 4 properties at 500,000 each, buying 2 of those, and they're fine. They wouldn't be allowed to name a 5th. It'd be over both the 3 property rule and the 200%. So it's strange stuff, and it does cause headaches once in a while, based on what people are trying to do. Any other questions about those? All right, next slide, please. All right. I get the question once or twice a week, all the time, where it's, hey, what I really want to do is buy a beautiful home up at Lake Erie or Hilton Head or Florida. I want it just to be a family vacation home. So I'm selling a commercial property in Columbus. I want to buy a beautiful vacation. I said, well, yes and no, right? Yes and no. We can make that work, but you're gonna have to give a little bit. A pure vacation home that you're not renting out, not trying to make money with it all, won't qualify as business or investment use. So it's not 1031 eligible. But the IRS came up with something that's very friendly. Click to the next one. Yep. So what they said here, it's very taxpayer friendly. They said whether this is applying to the property you're selling, or in this case, in our example, we're gonna say the property you're buying. They say make sure you rent it out at least 14 days in each of the first 2 years you buy it, after you bought it. Excuse me. They say also though, don't use it personally more than 14 days or 10% of the total number of days rented, if that gives you more than 14 days. So if you're renting it all the time, you rent it 300 days a year, you could use it personally 30 days in that year, and you're still within the safe limit. But if you can live with that for 2 years, where you rent it some and have minimal personal use, once it's year 3, you can do anything you want with the property and you can never be challenged. So year 3, you could go move into it as a principal residence. You could make it a pure vacation home and never rent it again, or you can keep doing what you're doing. But you can never be challenged if you live with this for 24 months after you buy it. It's called a safe harbor. Means again, you are safe if you do it. If you're outside of it, it doesn't mean you've broken the law. It just means if you get unlucky and they audit you, they could shoot it down. They could basically say, we're not convinced this is investment property for you, pay your taxes from that sale a couple years ago, whatever. Excuse me, it wasn't that. Makes sense? So it's in your book as well, all laid out in detail. All right.
Question.
Yeah, please.
So that last part where the replacement property must meet the same criteria. If the replacement property, if the one you sold, you're renting it out, okay? So you meet all the other standards,
Right.
but then the replacement property. You would, after 24 months, if you didn't want to rent it anymore, you could do that.
That's exactly right.
Okay.
After 24 months, if you want to take your new beautiful Hilton Head property that you didn't like ever having anyone in,
Right.
but you put up with 14 days of rental in the first 2 years, that's it. Now, once you're year 3, you can never let anyone besides yourself set foot in there again if you want. You're fine, never be challenged.
So that becomes your sort of a principal property, right? So what happens where you are living right now? So you can keep 2 at that time?
Yeah, I can't remember these slides, but I have stuff coming up, so I'll explain it now. We'll go into more detail if it does come up, but. If you want to turn something into a principal residence, that's sort of the next best tax break after dying, dying, it becomes a home run, no taxes are owed. But while you're alive, you can make taxes go away by changing property into a principal residence. So let's take that example. You've sold your commercial property. Sullivan back there helped you sell your commercial property in Columbus, but you didn't let them find you another property here. You went and bought a Hilton Head. And you do the 2 years of the minimal rental use. Year 3, you move in, right? What happens then is strange. Okay, we mentioned section 121 earlier that governs principal residences. It has a caveat that if a property was previously part of a 1031, now you have to own the property for at least 5 years before taking advantage of that tax break at all. Whereas if it wasn't part of a 1031, the rule is just that you have to live there 2 of the past 5 years to get the tax break. But people can do that every 2 years. You could sell a principal residence every 2 years and never pay taxes for most people. But here, you rent it out for 2 to meet 1031, go move into it in year 3. What happens now is every year that you live there makes more and more of the taxes go away. So let's just say you lived there for 9 years, and now it's time to go to the nursing home, right? So you had 2 years of rental, 9 years as a principal residence. 9/11 of that tax bill you would have owed goes away, and you have to pay 2/11 of it. So every year you're there, more and more of the taxes go away. Which is a great thing. Let's say the tax bill was still high and you didn't want to pay any taxes. You don't have to sell, you could turn it back into a rental, rent it for a while, then sell, use 1031. So people do that kind of thing all the time as well. You know, the more years you live there, the more tax goes away. That's laid out in there as well. Great questions. Any more? Any other comments right now? Anything else I'm not getting to? And do we want to go to 8 or what were you thinking, just so I can plan ahead here? I don't know how long you want me to.
We're going to midnight.
Yeah.
Love to do an exchange.
Does anyone else have any questions?
Well, no, I have more. I want to plan ahead a little here to get to tell you, but was it originally supposed to be 6 to 8 or 6?
6 to 8.
Okay, yeah, this is, that was planning on. I'm not gonna cheat anybody, but I just want to make sure.
Good, is this a good topic? Fantastic, okay. Let's go on through your few more slides.
Okay, good, yeah. I want to make sure I wasn't gonna go too long if we did too much stuff, but I know, I'll get you out of here early like I always do, but. All right, there are different types of exchanges. What we've been talking about has been the delayed exchange. That's what 90% of exchanges are, a 45 and 180 day period. You can do something called a simultaneous exchange. If Jim has the property I want and I have the property he wants, we could just trade deeds. That's the one type of exchange where the IRS does not force you to use a company like ours, the qualified intermediary, to hold the money and do the paperwork, keeping the IRS happy and so on. So if you're really just swapping deeds, you don't have to do business with me. That's sad, but you don't have to. That's a simultaneous exchange. The reverse exchange is if you need to buy your new property before you've sold your old property. Now, that can really be for 2 main reasons. One can be by design. You come across the new property, you love it, you got to buy it now. You're going to go ahead and close on it, but you just maybe don't even have your old property on the market yet. The IRS gives you a way to do it, but they don't make it easy. All right, what they say is you're not allowed to own both properties at the same time. Well, if you're buying the new one first, how do you avoid that? They say you have to use what's called an accommodation title holder, which is generally going to be our company. We're going to set up a new LLC. We're going to take title to that property on your behalf. And from that closing date, the IRS gives you 180 days to get the old property sold now at this point, and then complete your exchange. So right now, with markets being good, people have not had problems with the reverse exchanges for years now. But during the Great Recession, for example, some reverse exchanges failed. You couldn't get your property sold in 180 days. It just didn't always work. So there's good news, excuse me, and bad news when that happens. Let's start with the good news. The good news is you don't owe any taxes because you haven't sold anything yet. The bad news is you missed your opportunity to defer the taxes from that sale into that property you already acquired. So by law, we're always going to give you that property back within 180 days. So we're going to transfer it over to you, whether your property is sold or not. But yeah, if your property didn't sell, you paid us a big fee and you didn't defer your taxes. So that's not ideal. So you do want to be confident you can get your property sold. The other time reverse exchanges happen is when it happens by accident. You plan to close this week on your sale and next week on your purchase, but something goes wrong. The buyer of your deal, their lender falls apart, doesn't give them a loan. All of a sudden that gets majorly delayed, but the seller of your replacement property isn't going to wait. You have to close on that one. So that's the other kind of reverse really comes into play. I mentioned fees there, so let me talk about that. Fees for standard exchanges, in my mind, are fairly reasonable. We charge $1,000 to set up the exchange and handle the sale. We charge $250 for replacement property purchase. So 90% of exchanges have a total fee of $1,250 when all is said and done. That's generally not going to kill most real estate deals. It's pretty reasonable. Reverse and construction exchanges, I'll talk about in just a second. much more expensive, so you do have to factor that in depending on how big of a tax hit you might have. Because of the reverse exchange, like I mentioned, we have to go into title for you. A lot of bad things happen to us because of that. You don't really want to be in title on other people's properties. It's actually not good. We hold title to a McDonald's in Phoenix. Someone gets run over in the parking lot and killed, we get sued. We own the property. What happens quite often is crazy, but we'll own some property somewhere and 10 years, 20 years, even 50 years later, the EPA can find a problem with it. The problem was there when we were in title. They see us, they come after us, sue us for the problem. We try to avoid that, right? So we're doing a lot more homework on these deals. Any kind of a commercial property, we're gonna need a phase one that's clean to show there's no environmental problems, you know, underground leaky gas tanks or whatever else could be out there. Because we're not gonna want to go into title if it's gonna get us in a lawsuit later. We know it has a chance of that. So there's a lot that goes on. They also just take more work in general. The hardest part can be holding your lender's hand through the 1031 process when the lender's not used to that, maybe, and we have to go into title first for up to 180 days, then you'll be in title. There's work. So reverse exchanges for lower priced residential properties start at a fee of about $6,000 for that type of exchange and can be several $1,000s higher for more expensive commercial properties. So you don't do those for a small deal or something with not much tax. Yes, sir.
So, we are in process of selling this land, right? But, this year we bought 2 houses. And we have mortgage on that. Is there any way we can pay these 2 houses off?
Yeah, great question. Get that one every day, and unfortunately, I don't have good news on that answer, but the IRS does always require you, they require you to go out and buy a new property. And it really goes back to the thing I was saying at the beginning of why it's good for the economy. You know, if they just let you pay off debt, that doesn't really help anybody, but because they're forcing you to buy new property, that's a lot of money changing hands, that's people getting paid, that's income taxes and all that good stuff. So unfortunately, they don't let you use your 1031 funds to pay down debt. Yeah, if you acquire new property. Yeah, great question. All right, so after the reverse exchange, we've got the build to suit, also called a construction exchange or an improvement exchange. And again, a few pages, all these things, book for you. But the general idea here is you're selling your property, let's say for $1 million, you're gonna buy land for $100,000, but you're gonna build a $2 million building. Okay, and you say, well, wait a minute, shouldn't that count? Shouldn't I be able to, you know, spend my money on that and defer my taxes? Well, again, like with the reverse exchange, the IRS says yes, they give you a way to do it, but they do not make it easy. Okay. The hardest part about a construction exchange is you're still limited to the 180-day period. Okay. So we have seen deals through the years where they get a major skyscraper put up in a major city in 180 days. You know, $100 million of taxes on the line. Yeah, they'll work 24/7, 365 to get it done, or in this case, 180 to get it done. We've seen deals where people can't get a patio built in 180 days, right? Well, I just didn't get around to getting the permit, you know. So, you know, that's construction. We kind of understand that. So you got to plan ahead. If you're gonna do a delayed build to suit, you want to be able to acquire the property very quickly. We're gonna go into title on your behalf. Get as much construction done as you can. It's not required that it's complete. But at day 180, we've got to transfer it to you. You'll get credit for whatever the value of the land cost you, plus the completed value of real estate at that point. Reverse build to suit. I used to do these a few years ago, and I was usually dealing with rock stars and corporate CEOs. Okay, because it was aircraft deals. They would always buy the new aircraft first, because you can't be without an aircraft. Not when you're, you know, at that level. They're always going to buy it first. They're always going to deck it out the way they want it. They're going to spend a ton of money on it, figure out what they want to do with it. Then they're going to sell the old one, so they're never without an aircraft. So they're buying first and doing construction and selling. If you're, you know, Kroger and you need to buy, get a new warehouse up and running or something, you know, you're gonna buy it, you're gonna build it, and get it working, then you're gonna sell the old one once everything's moved over. Reverse build to suit, throw those together. So again, complicated, and timing is the big issue. Questions about any of the types of exchanges? Yes, sir.
So on the build to suit, if you acquire land, sell say a shopping center, buy land. Unless that land equals the cost of the sale of the other property. You could end up having to pay tax because not enough of the building is to be built on new land to be done in 6 months.
Yeah, I'm not sure I follow. Did you say the land alone is as much as the value of what you sold?
If the land alone is as much as building you sold, then.
Then you're fine. Yeah, you don't have to worry about the construction. We would need to go into title if that was the case. If you did need to add extra value, then we would go into title, give the rest of 180 days. If, if you get some done, but not all of it done, maybe you just defer some more taxes through it, but owe some still. It just depends how much you would get done in that time period. That makes sense? Okay. Good. Any other questions right now? All right. All right. This isn't really a new type of exchange, but just kind of something you keep in the back of your head that may apply to you once in your life, may not. But we call it the combination exchange. It's using a delayed exchange and a reverse exchange, or it could be the reverse first and the delayed, where you have at least one property in common. So I'll give you a couple examples. I did one out of Cincinnati a few years back. This company had grown and grown and grown to eventually where they had to buy another office building. And they grew and grew and grew. And they eventually were outsizing 2 office buildings. So they were going out, they bought this giant one, they were gonna put everybody under one roof. So they came to me, they said, all right, we're selling these 2, we're buying this one, we want to do a 1031 exchange. I said, great, it sounds very simple. It's kind of roughly speaking, a $10 million sale, a $5 million sale, a $20 million purchase. I said, well, not so fast. The 10 million's in contract. The new one we're buying for 20 million's in contract. But the second office building we need to sell is not ready yet. We have lease issues, whatnot. They had reasons it wasn't on the market yet. So, okay, you need the combination exchange. We're gonna do a regular exchange when you sell that first property for 10 million. You're gonna identify a $10 million piece or so of the new $20 million project. If for all your taxes from that first sale, very easy, just close within 180 days. They were already set to do that. But with the other one, that's not gonna be ready to even be on the market by the time we buy the new $20 million building, we're gonna start a reverse exchange. We're gonna take title with you as tenants in common to a portion of your new $20 million building. So maybe they own 75% of it and we own 25% of it. Then from that closing date on the new $20 million building, it now gives them another 180 days to get their second property sold, complete the exchange, defer all the taxes from both their old buildings into the new building. Another example would be someone comes to you and you're the real estate agent and they say, all right, I've got 10 $100,000 rentals around town. I want to sell those and buy $1 million apartment complex, right? So you say, okay, great. Can I package those together and sell them to an investor? And you say, no. I want them sold for one off. I'll get the best price that way, I think. So that's what's done. You're good. You get 6 of the 10 sold before they need to buy the new $1 million apartment complex in that 180-day period. But same idea. You start a reverse exchange when you buy it, giving them another 180 days after the purchase of the apartment complex to get the other 4 rental properties sold. So in a perfect world, you could have up to 360 days to sell the 10 instead of 180. Make sense? Yeah. So that's putting 2 types of exchanges together with at least one in common. All right. All right. The DST, the Delaware Statutory Trust. This is a niche product. When I walk into an average room, usually nobody or maybe one person has heard of the DST. Has anyone in this room heard of the Delaware Statutory Trust?
Heard of it, I don't know what it is.
Yeah, okay, so that's about right. That's about what we normally get. So it's interesting. There's something maybe you want to know about. They're probably not always going to be your first choice. But they can be helpful in certain cases. So people a few decades ago had a pretty smart idea. They said, why are we letting the major players have all the fun with the real blue chip properties? I mean, who can afford to buy a $50 million or $100 million property? Whether it's a giant office building in Manhattan, whether it's a perfectly situated apartment complex where there's always a waiting list and high rents, whether it's a bunch of CVS and Walgreens and have corporate backed leases where you know they're gonna pay, the perfect industrial properties, the very, very expensive blue chip properties. What if, instead of letting just the pension funds and the real estate investment trusts and insurance companies and so on get all those properties, what if we bought those and chopped them into pieces and sold them off to average investors? Where someone could sell a couple rental properties in Columbus, Ohio, take their $300,000 and invest into some huge project. People loved the idea. For a while, their accountants and their attorneys were nervous about it because they said, well, you sold over here as Joe and you're buying over here and what looks and smells like a partnership with a bunch of other people. We don't know if the IRS can be okay with that or shoot it down. Eventually, the IRS, actually in the year 2002, they blessed it. So 20 years ago now, they blessed the concept. It was called the securitized ticket at that time, tenants in common. We'd have a bunch of owners that weren't a partnership, so it made it work. And eventually, over time, it became the Delaware Statutory Trust, which is a better way to manage it. So it's no longer the tick on most of those deals, it's the DST. And the DST is just a way to own the property. But what happens is a company like Inland out of Chicago, they're the biggest player in this market space. They'll go out and they'll buy, again, it could be medical office, apartments, what have you. And they'll pay 50 million, 100 million for these types of properties. They'll go get a loan on it in most cases. Sometimes they do them debt free, sometimes 50% leverage, sometimes 75% leverage. They want it to be able to match up with what investors have coming out of their own deals. And then they'll go out and they'll sell it off. And you don't want to hear this part. Since they're sold as securities, right? They're not sold through real estate brokerages. So only someone with a securities license can get a commission. So these are sold through financial planners. But even our broker over here, there can be reasons that you want to use these for a particular client. Sometimes it's if someone just won't sell. You can't get the listing because they don't know what they're going to buy. They want to buy something with no management responsibilities like this, where they just sit back and collect their money every 30 days. Sometimes it's a backup. You know, you're at day 45 and you have the perfect property, but you think, all right, let's name something in case something happens. But a lot of times, I think the most common place I see it is that your client's happy. You sold their $1 million commercial property. You found them exactly what they wanted for $800,000, like one of our early examples. But they don't want to pay tax on that $200,000 difference. So they throw the $200,000 into a DST investment, that type of thing. So, you know, I could talk hours on this topic alone. It's a niche product. A lot of you may certainly never use it. I don't want to spend too much time on it, but it's just something good to know about. Yes, please.
The key question here to me is there anything left after after Inland takes their fees?
Yes, so it's interesting. So the real estate world in a lot of ways is just buyer beware. You go out and buy something, hopefully you've done your due diligence. Something goes wrong. We all know it's really hard to sue the person who sold you that property and get your money back somehow. It's not where you want to be. With securities, it is a little different. They will tell you everything, because if even 50 years down the road, you decided they left off something material, you're going to have a good lawsuit and you're probably going to get your money back if someone still exists to sue. So securities are very different. You're going to get that prospectus that's going to be that thick, and they're going to tell you if anyone ever sneezed on the property. So they're going to lay out exactly what all their fees are, exactly what your cash on cash return is going to be. And these things are not meant to be home runs. These aren't going to be as good as the properties that this guy's going to find. This is really meant for that scrap or that little bit where you don't want to pay all your taxes. And, you know, the return doesn't have to be as good to justify it. A lot of these over the last few years have been 4, 5, 6% cash on cash returns. And then sometimes, most of the time over this past decade or so, because we've been in a good period of real estate, they're getting great sales prices on these and your overall return shoots up quite a bit. Okay, that won't last forever, real estate will trend. But I can tell you from watching people do this for 2 decades now, a lot of people have been, the vast majority of people have been happy with these investments who are doing them. And they decide when they come out of one, they reinvest back into another one. Say tax deferred. And it's like any other real estate, you own it, they're set for a certain time period, they'll tell you up front. We're gonna stay invested for 5 years, then go sell this property. We're gonna stay 7 years, go sell this property. So you can plan for that. A lot of times they've sold quicker because they've got amazing offers. Because that's the market we've been in. So when that happens, they come to you and they say, hey, we're gonna close in 60 days. You know, congratulations, you got a 40% return on this one. And then they're gonna try to get you to roll into another investment, but you don't have to. You can take it out to your own 1031 and go find your own property at that point. You can take your money and pay the taxes, you know, it's no different than other real estate, other than really in the end, you have no control over it, right? Somebody else is managing the property, so that's gonna be very different for a lot of you. And it's a security versus just real estate.
But many of the people, so many people use it as sort of a third property to identify as
A backup.
a.
Yeah, absolutely. People throw it out there as a backup. Good questions on this? All right, please.
Do you have a question?
Am I thinking this correctly? If you did that, you don't have to do same value of what you sold. You only have to do the 200 gain, per se, on a trust.
All the same rules of a 1031 still apply. So, you know, if you sold it, what's nice about these really is that if you sold it for $212,000.50, you can go reinvest $212,000.50. Because you can buy exactly what you want to buy. You know, you can throw whatever.
Still have to do the full amount of the sale.
But you still have to follow all those earlier rules. Yeah, if you had mortgage debt on what you sold, most of these, like I said, have debt built into them already. So it's 50% leverage, you can use that to make up for your mortgage debt. Yeah, they're an interesting product.
So if you do an EST, you still have to go through an intermediator like yourself.
Yeah, everything's still the same.
Still the same.
It's just that instead of having the good sense to buy the replacement property for you, they're buying it through a financial plan. You know, in this case, okay, add a little extra with the leftover one, because yeah, it really does happen where, especially someone sells for 10 million and they buy for 9 million, but they don't want to buy $1 million property. They like big properties. Throw them there. Right? So, any other DST questions? All right, next slide, please. And you can skip past that one. All right, seller financing, I'll just mention here. There's a page in the book. It's a little bit complicated though. Really, you want to avoid it. When you're the seller on the front end of the exchange, a buyer comes to you and wants you to do seller financing. You probably just want to avoid that unless that's the only way you get your property sold. And I say that for 1031 purposes. The reason is the IRS treats it for 1031 purposes as if you received all of the money at the time of closing. You know, even though a huge chunk of it you're gonna get paid down the road, right? Financed. So when our clients are doing seller financing, there's only a few ways to keep it tax deferred. The first is when they act more like a third-party lender, like they're the bank, versus a seller finance. So for example, if they did 100,000 of seller financing for their buyer, they would actually bring the 100,000 to the closing table, provided the way the bank would provide it. Then that money gets into their exchange account and stays tax deferred. If they don't do that, it's going to be taxed. Another way potentially they can get around it, we do see this from time to time, but not really often. You can make the note through the 1031 exchange. The note actually gets sent to us just like the cash does. We put it in a physical safe in Chicago, and we have to hold it as part of the proceeds. And then they have to use the note in some way in the 1031. Sometimes it's creative, and not often, but sometimes they actually find a seller willing to take that note as part of the deal when they go to buy the replacement property. As the parties know each other, or they actually know who the person who owes on the note is. they're willing to take that. Sometimes the exchanger themselves buys it back before day 180 and before they buy their replacement property. So they didn't have the cash to act as a third-party lender on the front end, but they get the cash later. They can buy their note back and get their cash in their exchange, things like that. So short answers on that. There's more information in the book, but the real takeaway is try to avoid doing seller financing on the property you sell. On the property you buy, if you want to use seller financing, yeah, but no problem at all. You'll get credit for that, just like if you got it from a bank. So you still want to use your cash you have coming out of the down payment, but if you can borrow the rest from the seller, great. All right. Let's talk about the best topic of the night. Me. So you've heard me say this term qualified intermediary tonight. That comes from the Treasury regulations. With capital Q, capital I, qualified intermediary. I mean, that must be something special. All right, I'm going to show you the list. It's a long book. I'll show you the list of all the qualifications you have to do my job. None. There are 0 qualifications to being a qualified intermediary. The name really comes from the fact that you're not allowed to be disqualified. Okay, who's disqualified? Well, unfortunately, your broker is disqualified, your attorney, your CPA, your financial planner, they're all disqualified. Because you can't have an agency relationship between the QI and the exchanger. There's other people you would expect to be disqualified, your relatives, your employees. They want this to be a third party who in essence you can't twist their arm. Is an independent party to hold the money and do the paperwork, keeps the IRS happy. So, because there are no qualifications, you do have to be a little scared. Because anyone can do this business, and sadly, there's a lot of anyones who shouldn't be doing this business who do this business. Okay. Billions of dollars have been stolen, lost through stupidity, lost through bankruptcy of the QI. So, I don't want to turn this into a commercial for us. I mean, I really do, but I don't. But really, you're looking at financial strength. And like Ann said earlier tonight, we are by far the largest company in the country doing this, owned by that parent company, Fidelity National Financial. These giant insurance companies are our sister companies. And why that's huge is because they are nice enough to guarantee every deal that we do. So one of the documents you get in your package from us when you start an exchange, a document is in there that's the guarantee of the title companies that Ann is with. And they say, they don't actually use this language. It says if Greg runs off with your money, we have to make you whole. So they guarantee every deal up to $50 million per exchange. So we've been in business in the 1980s. No one's going to steal your money. We're very good. We're very safe, but things do go wrong. There's any company has bad employees, things happen. So if it happens with us, you're going to get your money back. If it happens with a lot of other companies, I've gotten the tearful phone calls. I've gotten many of them through the years. Really, I've gotten a person that I was at your seminar and I went with the other company. They were $100 cheaper, that kind of thing. They're not answering my phone calls anymore. Say, yeah, I've heard about that guy. It's a guy down in Florida. Yeah, he's gone. You're not getting your money back. That's over. You might as well start planning if you're not getting your money back. And there've been $1 billion sales that we've seen had to deal with. Billion stolen that we've had to deal with, big chunks. So we're not the only good company, but honestly, there's probably only a handful that are big enough and financially strong enough that you should work with. All right, what else? More slides, but I think I want to make sure we're almost out of time. We can really call it anytime people are ready. We're there, but. Anything I didn't get to, any topics you wanted to hear about, any things I went over too quickly? Yeah, please.
Well, the third block there where you say prepare legal documentation, does
Right.
that include the tax filing?
Yeah, so we're not allowed to do that. So we're allowed to prepare the exchange agreement, the assignments of contract, all the documents you need to do your exchange. They don't let us, I'm a lawyer, I'm still licensed and everything. But they don't let us give legal or tax advice. So we're not allowed to do your tax form, so you or your accountant will still do that.
But the documentation we would give to you, you just give it to your CPA. or whatever.
That's right. At the end of every exchange, we're gonna give you what's called a final account statement, and it's really gonna have the information your CPA needs. Yep. And we're always happy to talk to them and answer questions. We just can't give legal or tax advice. Yeah. No, good question. I always like to point out too, that we never charge anything for consultations. Our whole history of our company, we don't charge anything for that. So you can call us up and say, hey, let's have a conference call with, you know, my attorney, my accountant, me and so on. Let's see if this works. A lot of times it doesn't work. A lot of time I'll say for one reason or another, you know what, in the end, you can't do that. It's gonna cost you nothing. If it does work, you can still decide to go work with someone else. It's only if the deal closes, the money gets sent to the exchange account. We take out our $1,000 fee when the money comes in. Before we wire out the new property, we'll take out our $250 fee. It's that simple. We don't charge by the hour. We don't charge you anything else. Anything else?
The question on the tax period, for example, we have purchase having this year, but some of them will not be closed until next year.
Right.
Like you have something closed this year, or so let's say this way, some of them close this year, some of them close next year.
Right.
So what shall I be in comparison in that context?
Yeah, so the key, first of all, is gonna be that your sale, the relinquished property side happened this year.
Yes.
So that's the first thing you're really concerned with.
Yeah.
As we mentioned earlier, you're still gonna complete your exchange before you have to file your taxes. So based on when you started it, you know, I don't, probably doesn't go past April 15th. If it did, you weren't done, you gotta ask for your extension. But when you go to file your taxes by April 15th for the 2022 tax year, you're probably gonna be done with your exchange and you're just gonna give them all the information at that point. You're gonna file a form 8824. That's what shows you've done a 1031 exchange. And most of the form is pretty straightforward. It's a lot of when did you sell? How much did you sell for? Did you identify within 45 days? What day did you identify? How much did you buy for? When did you buy? To make sure you follow the deadlines and the numbers. They ask a lot of questions about related parties, which we didn't talk about tonight. You're not supposed to buy your replacement property from a related party, because that can be a problem. They ask a lot of questions about that. And then only the last section's a little complicated. That's where it's, hey, what was the tax basis of your old property? And you get into the real accounting part of it. But most of the form's pretty straightforward. But yeah, you're gonna file that form 8824 by April of next year, and you'll have completed your exchange for that. Yes.
Speaking of related parties, if you sold $1 million property and you wanted to buy a $2 million property with a relative, and you chip in $1 million,
Yeah.
and they chip in $1 million, that's.
That would work fine.
Okay.
Right, you're even allowed to sell property to a related party. You just can't buy the replacement property from a related party. In most cases, there are of course some exceptions. But in your case, you're talking about you sold for $1 million, you want to go buy a $2 million property and have a partner, right? And that partner is allowed to be a relative or a non-relative, doesn't matter at all. The only key is, again, it can't be a partnership at the beginning. It's 50% going to Jim's name, 50% can go to the partner. So you're gonna satisfy your numbers, $1 million for $1 million, they're getting the other $1 million, that's fine. What a lot of CPAs tell their clients is, once you get to January of the next year, so you're into the next tax year, if you guys want to contribute your interest into a 2-member LLC at that point, something like that, you're probably fine to do so. Yeah, originally, you've always got to match up to show the same tax benefit.
Great. When is the best time to contact you when you know you're selling a property? You do it at the closing?
Yeah, so
Or do you do it like, you want to give up a little heads up?
yeah, so the answer is no and yes.
I couldn't answer that one.
We get calls all the time from the closing. I mean, across the country, all the time. People come in, sometimes it's, oh, they thought someone else had taken care of it. Their attorney in line.
So we just went through 2 hours of what a 1031 is. I don't think you want to wait till the last minute.
Yeah, absolutely.
Consultative,
It makes everyone's life easier, it's the earlier the better. Certainly get to us, at least try to be a few days before the closing.
how about a month or so?
We do charge
Me
it
too.
we'll work very fast. We can do that because we're big. If it's the same day or the next day, we charge $250 rush fee, and we'll still get it done. But yeah, no, I get the call all the time from the closing table. We say, okay, that's not ideal, but get a cup of coffee. Ask the title company to send us the contract, the title commitment. We'll stop everything. We'll review those right now. We'll draft your documents, get them out to you. We used to always say we can probably get that done in an hour. That was pre-COVID craziness. During COVID craziness, we had to add rush fees and it wasn't always an hour. But we can get it done very quickly. So it's never too late as long as you haven't completely closed yet. But yes, be kind, like he's saying, let us know as early as possible, because we can do a better job for you if we can talk through things then.
I always like last minute. No. Keep showing your toe.
Any final questions?
Enough tonight. I mean, I want everyone to kind of mingle a little bit, do a little networking. It's important to know who we are, what we are, and why we're here. I mean, we're all investors. We're all looking to build a real estate portfolio. And I think this is a great opportunity. I've been in real estate, I think, 27 years now. After a certain point, you don't even think about it anymore, but like I've been working with Dan in Chicago, I want you to know the good people that we're working with, because it makes our job easier, it makes their job easier, they know it. So I want you to, shake Greg's hand before you leave, make sure you know who he is. Talk to Ann, because if you're doing a deal through me, we're gonna be talking to Ann anyway, because I throw our documents over to her. If I get a listing, I send it right over to her. I know right away what's going to be happening and how this transaction could be managed properly. So again, this is the first of the series. The importance of my next class will be in the first of the year, probably late January or early February. We haven't mapped it out yet, but it's going to be about cost segregation and value of that. If you're buying retail centers, what value that's going to bring to your table and the tax savings that will be. So watch for that in the future. We'll keep you on our what I call my preferred client list. People that are doing business that want to continue to do business. Who knows? One day we might be working with somebody in this room on a transaction. So that's why I want you to network also. Right. All right. Thanks for coming out. I appreciate your time today. And again, I appreciate you at Chicago Title and LA National. So thanks everybody. I appreciate that. Thank you, everyone. Oh, by the way, Allie has a gift for our guests today. They're out on the table here. We put a little package here. There's a millionaire real estate investor book. I think it's appropriate for what we're doing. I want to make sure that our clients pick one up before you leave. So please do so. Thank you. Okay.